Afternoon. Welcome to A Cup of Joe for the month of May. My name is Mike Carrazzo. I'm the content manager here at Ryerson, joined always by Mr. Worldwide Web, Nick Webb, our director of risk management, commodities hedging. Nick, how's it going?
Mike, I am doing great. How are you?
Doing well. And we have, as we have for the last few months, excuse me, we have a special guest with us today. Brent Pepich. He is the Director of Purchasing for Central Steel and Wire. We're going to be getting into a little talk on bar and a few of their products today. Brent, welcome.
To be here. Thanks for the invite.
Absolutely. Well, as always, no shortage of stuff to talk about. As I saw earlier this week, hot roll prices, cold roll prices down slightly. But in the bigger picture of things, what does it all mean? Nick's going to get into all that. Before we head in, I'm going to do as I always, give you the reminder next week. We'll have the full recording up on ryerson.com on our YouTube channel. If you want to participate, ask us questions along the way. There's a Q&A button down there. Give us a shout. We'll try to answer them as we go. If not, we'll also do it near the end. And if we can't get your question, we'll certainly try to follow up as best we can. So, Nick, why don't you take us away for the month of May?
Absolutely. And we've, in addition to the intro music, we've actually got a video in this presentation. So I'm actually going to have to hop back out real quick, reshare my screen so that I've got the sound included. All right. As Mike said, we have tons that we can talk about, tons that we will be talking about, tons that hopefully we're going to get to in the Q&A. There's a lot of volatility, a lot of headlines going on right now, a lot of it really dealing within the commodity space specifically. So without spending more time on the intros, let's go ahead and hop into things. First things first, as we always do, we need to touch on the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, Brent Pepich. These are not the opinions of Ryerson. This is not investment advice. Do your own research. But we are going to present to you the best data we have at hand, or at least that we believe we have at the moment. First things first, the elephant in the room. If it seemed at all as if I was distracted at any point during last month's Cup of Joe presentation, it's because I was. I was actually in the office last month. And as you can see, I've got a fan base. Cup of Joe actually has an expanding fan base right now. For those who are not part of the Ryerson team, unless you're in the Texas market, you will not know who this is. This is our head of the multi-market region down in Texas, Alan Singleton, covering a lot of the oil and gas markets. He was in the office, took a very keen liking to the fact that we're doing the recording and decided to take some selfies. So yeah, in addition to all the things Alan does for Ryerson, he's also the chief selfie officer. So we appreciate him partaking in the presentation last month.
He was very excited to get that photo, by the way. And what you can't see is there's a giant line behind Alan. There's about 10 or 12 deep of others looking to take a selfie there. So yeah, that's a rarity right there.
Yeah, so we appreciate all of our fans. We want to thank you from the bottoms of our heart. With that said, so this presentation is probably going to feel a little more spicy than normal. The first couple slides are a little dicey or a little more aggressive. I think we'll be able to wrap it up on the macro side by kind of giving a little more optimism, however, and then we'll hop into Brent's portion of the presentation, which is going to cover long products, and then I'll cover carbon, aluminum, and stainless. So we touched on this chart last month, and so I'm not going to spend a whole lot of time in the detail of what exactly we're looking at, but this is a chart showing the two-year yield versus the 10-year yield. Ultimately, going back 40, 50 years, when the yield curve, or in other words, the 10-year treasury dips below the 2-year treasury, it can signal an early sign of a recession. I noted last month that oftentimes it typically leads a recessionary type situation by, let's call it 18 to 24 months. So it's not immediate, it's not an impending doom, it's not sky is falling. But it is certainly something that we and a lot of other economists are certainly watching to try and get a gauge of if and when some of these markets are going to slow down. Similarly, and I guess I do need to back up for one sec, what is a recession? Technically, a recession is 2 consecutive quarters of negative GDP growth, so a negative GDP print. Unfortunately, even though I mentioned in the call last month, I mentioned that this typically leads by 18 to 24 months. A few weeks ago, we got a surprise GDP print for the first quarter of 2022 of negative 1.4%. So half of the qualifications for being in a recession are kind of here. I will caveat this very, very heavily by saying this is an early read GDP print, which means not all of the data is yet accumulated into the GDP print, but it is certainly that's a bit of a, take a step back, a little bit of a yellow flag, because this could signal that things are actually slowing down at a faster pace than what we had previously predicted, or what any economist is really predicting. So something to keep an eye on. Additionally, and this is very fresh, just yesterday, the Federal Reserve hiked interest rates to try and cool off inflation, cool off markets, cool off excesses, but at the fastest rate that they've done since the year 2000. So there is certainly an effort from the Federal Reserve to try and cool things down a little bit. What we're looking at here is the current forecast of the trajectory of those Fed rate hikes. And as you can see over the next basically year, there's an expectation that rates are going to basically go off their 0% level and head up towards somewhere in the 2.50 to 3% range. Now, what does that mean for all of us within the manufacturing community? We're going to find out. I've got some thoughts on this, and I think it's going to mean different things for different types of companies, and that's why I'm deeming this kind of the tale of the tortoise and the hare. We could call it the tortoise and the hare. We could call it growth versus value. We could call it old economy versus new economy. These aren't new topics that we've talked about in prior Cup of Joes or in the Engage in January. But what we're looking at here is just an example, high level, of how I think things are playing out with regards to where we are in this situation with regards to the business cycle. On the left-hand side, you've got old Warren Buffett. He's, 90 to 95 years old. He's the head of Berkshire Hathaway, which is going to be a conglomerate of a lot of value type companies, things like Chevron, things like Apple, Coca-Cola, Geico. Some would deem those to be boring companies. They're kind of old school. On the right-hand side, some of you may not know who this is, but she is the CEO of a company called ARK Invest. She has an ETF, which is a basket of companies, that's called the ARK Innovation Fund. Very much so, unlike Warren Buffett, it is comprised of companies that are very futuristic, tech-oriented, what we may call growth companies or riskier companies. When times are good, they tend to do very well. When times are bad, they tend to struggle a little more. So we're looking at companies like Zoom, Teladoc, Coinbase, companies that did very, very well early on in the pandemic and the lockdowns. Now, why do I bring this up with regards to the manufacturing sector? Well, when we look at their performance going all the way back to the inception of ARK's fund, and again, keep in mind that ARK is more of a high risk, high technology oriented fund, you can see that when the pandemic happened and a lot of the stimulus happened, interest rates went to zero, companies within the ARK portfolio, so companies like Zoom, like Teladoc, companies that were very reliant on software as a service, they took off. They absolutely screamed, and Cathie Wood kind of became a mini celebrity within the financial community. And you can see it here, comparing to Warren Buffett and Berkshire Hathaway, who some would call one of the best investors of our generation. She and her fund completely outperformed the Berkshire company or conglomerate. What's happened since then? Well, the last 12 months, we've seen a little bit of choppiness. And then as interest rates start to tick up, the ARK Invest portfolio has very, very quickly come back down to earth. And I think I want to take a second to be sympathetic. I am not celebrating in any way those who lose money, those who may have been invested in high-end technology companies, things like that. Certainly want to be very sympathetic of that, because losing money is no fun. But there is a potential argument to be made that we kind of have a situation like the tortoise and the hare, where ARK Invest kind of represented that company that was very high flying, very risk oriented, very growth oriented. And in a rising rate environment, companies like that tend to struggle a little more, whereas companies like Berkshire, which would be the tortoise in this situation, can perform quite well on a relative basis. And what's interesting is they've taken very, very different paths to get to where we are today, but on a return basis, we've basically wound up on a similar wavelength over this, let's call it 7 to 8 year time period. So I found this chart pretty fascinating. I sent it around to my my executive team actually, because I think it's a good representation of sort of where the manufacturing economy sits as well, because I would say that the manufacturing world is a little better represented by the Berkshire side of things, which is slow and steady wins the race. Things are still ticking along at a pretty decent pace. And I think that's really where I want to focus the conversations on the macro side of things, because don't get me wrong, there's been a world of hurt within mostly tech companies, but companies in general with regards to their stock prices over the last 6 to 12 months. Those losses are real. Those market cap destructions are real, but that is sometimes what happens at the or near the end of a business cycle. You can see that conversely, things like Berkshire Hathaway, things like manufacturing economies, I would argue can, and I see them looking pretty strong for the balance of the year. So it's sort of a situation of the haves and the have-nots. If we look at the stock market, we turn on CNBC today, things look dire, things look scary. But I think when you look at things like commodities, things like manufacturing businesses, things are looking pretty darn good. So I wanted to make sure I followed up, the doom and gloom at the very onset of this presentation with this idea of the relative value of where we've been and where we've come to.
Hey, Nick, real quick on that one, does that speak to in a few of the past Cup of Joes, you've spoken to what you call the revenge of the old economy, right? Where is this kind of on a similar path that way? If you look at Berkshire as kind of the, we'll call it the old economy, the tried and trues, right? And ARK being those, correct me if I'm wrong, like Tesla's in that fund as well, right? So.
Sure.
Does this kind of speak to that revenge of the old economy a little bit?
I think it's absolutely that case. And again, that's my personal opinion, but my belief is that we've gotten into a situation now where, and we've talked about this for a number of months, we've got shortages of oil, we've got shortages of food, we've got shortages of metals in many situations. And I think it's going to take us, kind of pulling the Band-Aid off and realizing we need to have more investment into the creation of things, and I mean physical goods, not software, because even if we think about software being the future, which it may very well be, the metaverse may be our future, you can't have the internet without copper wiring, and you can't get anywhere without having physical infrastructure. We all know we need to eat, we need shelter. These core basic principles, I feel, have kind of been forgotten, and they're starting to rear their ugly head and create situations for all market environments. And we're just now really feeling the pain of some of these. Obviously, last year we saw some of that within steel, but I think it's shifting into things, and we'll talk about this in more detail here in a few slides, but we're feeling this pretty hard within the energy sector. There's some food issues that are beginning to creep up, certainly within the European region and third world countries. But yeah, I think we've lost sight of what priorities in life we should have, and we've gotten a little too focused on the 30-year technological future, and we've forgotten that we still need to feed ourselves with food. So yeah, I think this is coming home to roost a little bit.
Yeah, and I think what fascinates me most about this chart, right, if you look at the onset of the pandemic to about where we are now, that huge divergence, it shows that as things ramp down, that kind of supported, that it kind of showed that's how productivity, that's how business was happening, right? Zoom, things like that, all these tech. And then now as things start to even out, they're coming together a little bit more. It shows that this really can support when something like this occurs. But then, like you said, it still comes down to making things and those things kind of converge here. So this is a really fascinating chart.
I thought so as well. And I think it's corroborated when we look at commodities specifically, which we've looked at this chart in the past, but this is showing in the white line is going to be the Bloomberg Commodities Metals Subindex. The blue line is going to be the energy, and then the orange line is going to be your agricultural index. Same thing. This is basically the normalized return of all of these commodity baskets going back to 2020. All of them have been absolutely on fire. not the least of which energy is continuing to outpace on the upside. And we'll talk about that in more detail. But all of these issues, they were issues prior to Russia invading Ukraine. They've gotten exacerbated to a large degree by that invasion, by that potential blockage of goods coming out of that country. It continues to be the case today. If anything, it's probably getting incrementally worse. Just this morning, the U.S. administration indicated that they're going to try and seek to buy 60 million barrels of crude oil. So, in a world where we've had for several years now, we've been talking about ESG and the attempts to try and get away from fossil fuels. Unfortunately, it just doesn't look like that time is here yet, because if anything, we're having a heavier reliance on fossil fuels, on metals, because we've had supplies cut off from the Russia-Ukraine regions. And as we look over on the right-hand side, you can see the relative market share of Russia is quite large in a lot of these different commodities. And God forbid, I mean, there is a real risk, and it's starting to creep up a little bit, that Europe is trying to contemplate how they're going to cut off Russian supplies of oil into their country or into their continent. And in doing so, there's the counteracting threat that could be Russia could just say, fine, you can cut off oil, but we're going to cut off aluminum, we're going to cut off nickel, we're going to cut off palladium. They may respond in kind, in which case these issues that we've been seeing could get worse. Now, I'm not saying that's my base case, but it is certainly a risk that retaliation is a real thing. And this is not just a physical war. This is an economic war. It's a commodity war, and it's rippling through the markets. And I guess one last thing I'd say on this chart is, the Fed can hike interest rates all at once. It can take interest rates up to 5 or 10%. Unfortunately, that doesn't create more crude oil. That doesn't create more food. So really the only way you can get to that point of having supply demand balances is one of two ways. One is you create demand destruction, where prices get so high that people just stop buying goods and that demand side of the equation tapers off. Or you have to incentivize investment into some of these core foundational things. And unfortunately, that takes time. That takes a lot of money. It doesn't, certainly not going to be an immediate fix, but those are really the only two ways that I can see that this thing comes to a resolution. And with that said, kind of wrapping up, I normally touch on this chart first, but this is looking at the global purchasing managers indexes. So anything above 50 is going to be suggestive of growth. Going left to right is going to be May of 2021 through April of 2022. And you can see we're starting to see a couple patches of yellow. We've got one obvious patch of kind of an orange-red color, and that's going to be China, which unfortunately, here we are more than 2 years into this whole pandemic situation, and they're still in full-on or back to being in a full-on lockdown situation for a number of their big cities. So you've got 100 to 200 million people who are full-on lockdown in Shanghai, Beijing, a number of other big cities. So their economy is certainly experiencing some headwinds. What's kind of crazy when I take a step back and I think about the global manufacturing economy and commodity markets, it's kind of crazy to think that we have a China that is almost fully shut down, and yet we still have aluminum prices up near multi-year highs. You have nickel prices up near all-time highs. You've got crude oil at $110 a barrel. There's this kind of a scary situation that could happen if and when, and I do think it will be temporary. I think these lockdowns within China will be temporary. If and when China comes back and they come back to the demand side of the equation, things could get tight again. Things could get kind of interesting. We'll see how it plays out. I don't know exactly how that goes, but what I will say is when we look at the European economy from a manufacturing standpoint, and we look at the United States, most of this data is suggesting continuation of year-over-year growth. So again, even though you see a lot of doom and gloom when you turn on the financial news, I take a step back and I'm hearing a lot of positive things from our customers. I'm seeing a lot of positive data within the manufacturing world. And I think fortunately or unfortunately, a lot of these themes that we've seen within the commodity space over the last 2 years really haven't changed all that much, because again, until you get demand destruction or until you get real investment in the supply side of the equation, these things are going to persist.
Yeah, it's an interesting look at the PMIs you do every month here and kind of where the world sits, I guess, with production. Very interesting.
Yeah, I totally agree. So with that said, we are going to transition over to Brent here in just one sec. But first, I was actually watching, whenever I'm working at home, I have CNBC on in the background, which sometimes can drive somebody mad. But about 2 hours ago, they were talking about something that seemed extremely timely. Unfortunately, it was so timely that you can kind of see I had to film this with my cell phone in my living room. So I didn't actually get the footage straight off of CNBC. So the audio will be a little difficult to hear, but I think this will be a great transition into talking about long products with Brent. So let's all be quiet and hop in and give this a listen.
Exactly. That said, what's he going to do? This is not an isolated incident, right? Commodity prices of all kinds have been breaking out to new highs this year. There is huge global demand, and there is not enough supply to meet it. I don't care which commodity you want to pick.
The biggest problem is people, the ultimate intellectual commodity, right? Talking to producers in the Permian Basin, they're going on short shifts now because they don't have enough people to run 24/7. Oil's a hard business. It's hot. It's super cold. It's dangerous. You can get paid well, but if you can get paid just as much to work at a desk or a safer job, one, by the way, that doesn't take you away from your family for weeks at a time, you might look at that better option. Shortage of labor and shortage of steel casing for tubing for oil pipes is a huge deal right now.
Great points. Again, there's the net gas price.
So with that, I think there's a lot to digest in there. And for those who get the chance to watch this again on YouTube, certainly recommend it, because I think not only is this going to be a good summary of the long products market in the carbon world, but I think some of the earlier things they said with regards to labor shortages, difficulty to hire people within the current environment. Those are all things that Ryerson's dealing with. I think a lot of our customers are dealing with, and are certainly the theme that do not seem to have a resolution for in the immediate term. They may get better, but it's going to take some time. But with that said, I'm going to kick it over to Brent Pepich, who is our Director of Purchasing. He specifically resides within our Central Steel and Wire subsidiary, but he's all part of the Ryerson Big Happy family. So he's covering long products. So Brent, go ahead and kick it off for us.
Yeah. So first of all, I'm gonna mention a couple obvious things here. The whole world has changed over the last 2 years. We probably saw the tubing market starting to tighten up maybe in November of 2020. The bar market started tightening up in March of 2021, and it's just continued to tighten. This is one of the longest periods of time that I've seen the market be as tight as it is today, and I don't foresee that things are going to ease up anytime soon. And when we talk about people shortage and labor shortage, that's a big problem. Every mill I talk to, are you operating at capacity? Well, the answer I get is we're operating at capacity with the amount of people we have. I had a mill today where they were operating at about 1.5 shifts. They were planning on going to 2 shifts in third quarter. And now are they not only going to 2 shifts, they're only going to 1 shift because they don't have enough people. And they've booked orders at a 2-shift pace. So that's going to create some problems out there. So this people problem with all companies is real. And I don't see that easing up anytime soon. One of the things, just so you kind of get a flavor about where the majority of my background is, Central Steel and Wire strengths when we're talking about bar is really in your cold finish carbon and alloy bar, your hot roll SBQ market, and your hot roll merchant bar market. So that's where the majority of items I'm going to be talking about. In tubing, it's DOM, it's electric welded tubing, round squares and rects, and then structural tubing, round squares and rects. Those are our main strengths. Go to the next slide, it's fine. So this will give you a little bit of an idea of how the market's changed from a price point of view over the past 20 months. And again, I don't think I've ever seen a market, at least in recent years. I've been in the business going on 38 years, and I can't recall some products going up as quickly as they have, and for these prices to sustain as long as they have. And again, for the extended lead times to continue as long as they have. So in these figures I'm going to be giving you are kind of average figures from all the mills we buy from. You know, there might be some mills where pricing's a little bit different, a little higher, some a little bit lower, but I'm kind of talking about averages here. Structural tubing, we saw a total of 18 increases, totaling $82.50 a hundredweight. Then when carbon flat roll started going down, we saw 6 decreases, about $34.25 a hundredweight. And then we had 3 increases of $25 a hundredweight. And again, I've never seen the market move like this. That was over 17 days. The market went up that much. And that's when things really took off again with carbon flat roll going through the roof. So the net up on structural tubing over that time frame is $73.25 a hundredweight. DOM, we've had 13 mill announced price increases totaling 89%, but these are incremental increases. So when I did the math on this, you're actually looking at an increase of 136% in DOM pricing from where we started. Cold finish bar, there were 7 base price increases totaling $21.25 a hundredweight. Except for thermally treated bar, there was an additional $7.50 a hundredweight increase in those products because of rising energy costs. So when you take the base price increases of 21.25, and then you also have to add on to that the scrap surcharge increases over that time frame, which were $26.08 per hundredweight. And that scrap surcharge increase is being driven by number one, busheling. You've actually over that time frame seen prices on the average cold finish bar item go up $47.33 per hundredweight. You know, pretty much the same on the hot roll SBQ side. A little less increase on the base side. Again, thermally treated went up. Again, more than regular as rolled product. But when you look at the base price increases and your surcharge increases again, you know, you're up over $45 a hundredweight. And, you know, you're talking about some products that were probably in the you know, 45, 50 cent range to begin with. So when, you know, again, you're talking about virtually doubling your price on some of these products.
Yeah, Brett, one of the things, so I apologize to interrupt. One of the things you said that I found pretty interesting was sort of this compounding effect of energy prices or of inflation generally, which was the price of long products maybe going up because of energy, but those same long products go into producing the energy that would actually bring prices down. There's a very interesting relationship there where it just seems like it's a circular effect.
Yeah, and you know, I'm waiting for that shoe to drop because, you know, energy in this market has been relatively soft during this time frame, and you know, it's starting to pick up a little bit. And I mean, if energy starts getting real active again, you know, we're gonna have some more pressure on hot roll SBQ bar, especially.
So I don't want to jump the gun on future slides, but where do we get it? I mean, so if we have the administration saying we need more oil, we need more energy, you know, and the energy companies are saying, well, we don't have enough people, we don't have enough long products, tubular goods. Is there an import source that we can get it from? How do we fix this situation?
Well, the things that have driven prices up have been worldwide scrap shortage and worldwide steel supply shortages. So that's where the problem's coming from. Hot roll SBQ bar, normally there's quite a bit coming out of Europe, but because of the constraints that they have in Europe and the energy costs in Europe have gone up. I mean, we think we have problems here. I was talking to one year at the mill in Spain, and I think their electric bill went up tenfold over a year. How can you produce steel? How can you compete worldwide when you've got energy costs like that? And then, all the problems going on with the Ukraine, Russia, that's also stretching into other parts of Europe. There's some, we think we got a people problem. There's some mills in Europe where the Ukrainians have actually left, other countries other than Ukraine, they've left their jobs in mills in other countries to go home and fight. So that was something interesting I was reading about. So yeah, it's a problem. Hot roll merchant bar, 10 increases totaling $26.50. Usually merchant bar pricing is driven by shredded scrap. It's driven by whether there's any imports coming in, and it's driven by how busy the mills are. And the mills have been pretty busy with hot roll merchant bar. There's not much foreign product coming in, and shredded scrap is at an all-time high right now. But they're expecting it to come off its all-time high here maybe within the next week. So lead times, and this is where it gets really crazy, because when I talk to people about these lead times, they're wondering if I was a weatherman before this, where I'm not held accountable. But structural tubing, when I'm saying 2 weeks, there are items you can still find on the floor at the structural tubing mills. We have a lot of VMI programs for structural tubing, so there's still a fair amount we can pull in with 2 weeks. But if the mill doesn't have floor stock and you got to get into a rolling, you could be looking at a 3-month lead time. Electric welded tubing, same thing. You might be able to find some stock on the floor, but not as much as normal. We have VMI programs there, so I can pull material off the floor, but you might have to wait 3 months if you can't find something on the floor. DOM tubing is really become problematic. The only way you're going to find DOM tubing on the floor in 2 weeks, there are several brokers out there that buy foreign material and carry material on the floor. You might be able to find some sizes within 2 weeks, but if you're placing a new order at one of the domestic DOM mills, at least at one of the big three, you're looking into first quarter next year. One of the big three mills is out to February, and the 2 other mills haven't even opened up their order book yet, and they haven't talked about it, but I'm starting to sense that if they haven't opened up their order book and things are going to continue the way they are, they might be thinking about going to some type of allocation program in the first quarter.
So Brent, we talked about this idea of demand destruction as being a potential alleviating factor to inflation or availability. Are you seeing any situations of customers saying, "No mas, I'm walking. I'm not playing this game anymore," and they search for substitutes, or are they, most of them, still waiting?
Well, there are some products. I mean, we've got one product we carry that only one mill makes, and there's really no good substitute for it, so they have to wait. When we the thing is, when we first got into this, say first quarter of last year, a lot of the large OEMs we were dealing with, I was on a lot of conference calls talking to them about supply and demand and what was happening in the market. And probably by April, they weren't worrying about steel anymore because they had problems that were much bigger than steel. So, it's really the all-out issues that everyone was having with all their various supply chains. And again, it's not, for some of these products, it's not about price anymore. It's about do you have it? When can you get it to me? And making sure you follow through on that promise. I'm working with one large OEM right now where their subcontractors are having difficulty getting a hold of material from their mill sources, and there's a little bit of panic going on. So it's an interesting market.
Well, not to interject here, but it almost kind of speaks back to, Nick, your chart, Berkshire versus the ARC, right? Was it?
Yeah.
So, if you're not getting the material to buy to build things, in some of these cases, you said till first quarter of next year, how does that production kind of ramp up? It's always a fascinating question to me. I talk to our product managers, like, if you're looking at, you can't purchase this stuff for 10 months, what's the best way to plan? And it's really a,
well, no, that's the thing is, we're trying to get the best forecasts we can from our customers, and then we're also trying to base things on past history. But we all know, especially the way things have been the last couple of years, trying to predict the future from the past isn't a good is a recipe for disaster. But you got to do the best you can. If my lead time on something is February, I'm placing orders for February. I've got orders that might be coming in August, and some more coming in October, and some more coming in December. But trying to guess, what you're going to use over between now and then, and what you're going to need by then, for anybody, including the large OEMs we do business with, is extremely difficult.
Yeah, I mean, Mike, it kind of echoes back to some of the conversations we had about some of the big automotive companies who, certain products or certain things, and specifically it was like valves and semiconductors. The automotive makers tried to work around that by doing a work in process, completing the things they could, and then installing whatever parts were lacking later on. So yeah, I mean, people are getting more and more creative for sure.
And you mentioned it slows, obviously, because energy uses a lot of this. What are some of the other markets that are really, you're seeing a big impact right now, right, on this?
Well, ag has been big, heavy equipment. Those two have driven like the DOM market out, hot roll SBQ market out. But even automotive uses a lot of small diameter bar. But it's a combination across the board. A lot of these manufacturing facilities had to play catch up after coming out of the pandemic. They had backlogs, and they're trying to increase their production at a time when it's very difficult for some of their supply chains to supply them with everything they need. And I have one big customer who was looking at increasing their manufacturing rate at 30%, giving us a 2 to 3 month notice when there was a 9-month lead time on the product. So those are interesting things to try to work through.
I have a lot of those types of conversations as well. It's incredible.
This may be along those lines too, but the question just came in for the audience. Are you finding that many suppliers that as affected this aren't quoting price at the moment?
Well, I mean, what the mills do, especially with the long lead times, is they all quote price and affect the time of shipment. You don't know what the price is going to be until they ship it. Some of the mills, you have a chance to cancel the order if you don't need it up to a certain time frame before the order is due. And that varies by product. But, it's pretty easy to follow what's going on in the market and where prices are. And it's just, if you need product, stay in business, you're going to pay whatever the market price is for that product at that time.
Which is going to make keeping that lid on inflation very tough, at least within the world we deal in.
Right.
Well, Brent, we really appreciate your time here. We're going to ask that you hang on for maybe another 15 or so minutes. for the very end. We may have some Q&A that'll be dished your way, but great information. Really appreciate that.
All right, thanks.
Hey, Nick, and before we move on, I should say this speaks what Brent was talking to, especially in the energy area, really speaks well to the, I think I mentioned last episode, we're doing these mini segments called Shot of Espresso. Kevin Bury, our in-house oil and gas expert, talked about these very things that Brent was talking about, the shortage of labor, how, like you said, Nick, you can't, there's no demand, but you can't build the stuff to get demand. So I'm going to share the link to everybody here in the chat to that. If you haven't had a chance to watch that one, it's a quick 10-minute segment. I think it's definitely worthwhile.
Yeah, it's great. It's great. It's really well done. So flipping over to the carbon flat roll side of things, we've looked at this chart many times in the past. Ultimately, the most recent rally 2-3 months ago really kind of started within the European region because as we've noted, Europe's got a much closer geographical footprint to Russia, Ukraine. As the invasion began, there was a fairly large panic within the European region for steel products, whether it was scrap, whether it was iron ore, coking coal. And you can see that here in this chart. The blue line is going to be your European steel prices. It really led the US rally. So a couple weeks later, the US market, which was trading down around $1,000 a ton on the hot roll contract, traded up about $500 or $600 very, very quickly. You can see that here in the white line, which is basically just a straight vertical. Since then, I will admit that we have had a little bit of that panic subside. So Europe has found other sources, in part from China, who is obviously in a very, very swift lockdown, slowdown situation right now. So Europe has been able to find some replacement substitute sources. So you can see in both the European situation as well as the US situation, we are beginning to see carbon sheet markets drift back lower a little bit. Additionally, what we're looking at here is going to be the busheling scrap price in the blue versus iron ore in white. Both have kind of rolled over a little bit. Iron ore not too much, which is actually kind of surprising given the fact that China is basically in half the country is in lockdown right now. So it hasn't moved lower by a massive amount, but certainly coming off the high levels is scrap. Brent mentioned it briefly, but we are expecting to see probably a $50 to $75 move lower in the price of scrap. So all things being equal, that should make it a little easier for steel mills, particularly electric arc furnaces, to produce steel profitably at slightly lower prices. But if Brent's commentary was any indication, steel markets really across flat and long products are still extremely tight. So, what normally may have been a $250 to $300 spread between scrap and steel, you probably got to widen that out by a fair margin just because markets are still pretty tight within North America. And interestingly, within the futures space, we've looked at this chart many times over, but the blue line is going to be the steel futures curve, the hot roll coil steel futures curve, as of 6 months ago in the blue, a month ago in green, and then the current pricing is shown in orange. Really, it may not look like a whole lot because directionally they're all kind of pointing a similar trend, but you look at the gaps between some of those prices along different spots on the curve, and you're talking $200-300 moves. So basically in the last month, we've seen steel futures drop by about $300 on various parts of the futures curve. We are admittedly beginning to see some customers step back into the market and do some hedging so that they can lock up their prices. It's kind of a little quick commercial, not a suggestion or anything, but we do have the ability to lock in futures prices so that we can give our customers fixed prices on steel. And a lot of the downward trajectory that's currently expected in the market is basically priced in. It's being priced into the future space already. But yeah, it's been pretty fascinating that over the last 3-4 months, we've seen a pretty swift roller coaster of prices coming down sharply, going up sharply, coming back down. Unfortunately, this volatility that we're seeing within metals and more broadly commodities seems like it's going to be with us for a little while as we sort through the supply demand balances. Shifting over to aluminum, I like charts. If you can't tell, if you haven't been able to notice that over the last year and a half that we've been doing this, I love to look at charts. I think charts tell a very interesting psychology story about markets. And so with that, I also enjoy technical analysis, which basically just means drawing lines onto a chart. But this one jumped out particularly fascinating to me, which is this is a 5-year chart of LME aluminum. You can see that about 2 months ago, I think it was 2 months to the day, we hit record high prices of about $1.75 on just the LME ingot portion. We have come off fairly swiftly from that on a couple things. One I would say is certainly rising interest rates, or the fear of rising interest rates, is going to act as a headwind. A lockdown China is going to have an obvious headwind on the price of aluminum because you're taking out a big piece of the demand side of the equation. But interestingly enough, when you draw in this trend line, which I love doing, we are still in an upward trend with regards to LME ingot prices. And I think it's going to be a very interesting next couple of days, couple of weeks, because as I mentioned, some equity markets right now and some broader markets globally are experiencing quite a bit of volatility. It'll be interesting to see if aluminum can hold up above this trend line. If it does, it may suggest further constructive support for prices. And I would say I don't think this is too much of a reach. Certainly, if China reopens its economy, opens up its cities, gets back to demanding the things that they traditionally demand, I would expect that this chart to remain relatively supportive. But we'll see. We'll see. There's quite a bit of quite a bit of noise going on in broader markets at the moment.
Nick, that's a little bit of that drop has occurred like over what, the past 2 weeks, we'll call it.
So it's actually 2 months. So that
2 months.
That all-time high was March. I think it was March 5th of 2022. So it's still very quick though. It's been a very swift move.
So one of our attendees are asking about have you seen a drop even in the past few weeks from that, or is it just part of the trend over the last 2 months?
Yeah, no, I would say if anything, it's sped up in the last week or two, along with a lot of other risk assets, equity markets, things like that, because they're all somewhat correlated to some degree. But yeah, it's been. I mean, this is all very fresh data. So yeah, this is. I would say the last 2 weeks we've probably seen 10 to 15 cents come out of the price of LME. Now on the flip side, Midwest premiums are remaining stubbornly high, basically right up near record levels. And I think Harbor actually put out, which is a subscription aluminum company for research, they put out a note just yesterday or 2 days ago suggesting that the Midwest premiums are in the physical market are going through upwards of 40, I think it was 42, 43 cents, which again, that's a record high level. And unfortunately, one of the contributors to that is what we're looking at here, which is the price of diesel fuel. I know we had Elizabeth Efta on to talk freight markets last month. If anything, things have just gotten crazier within the diesel fuel market. You can see it here in this chart. We're talking about a lot of different regions of the United States with diesel prices above $6 a gallon, which that's going to feed through to, moving things around more expensive, manufacturing things more expensive. It's really kind of it's a rising tide lifts all boats. I've heard diesel fuel referred to as the workforce or the workhorse of the manufacturing economy, and right now it's getting more expensive very quickly. So a lot of the things we talked about on the energy side are certainly going to be very applicable within diesel fuel. So what that means for Midwest premiums is getting ingot into the Midwestern portion of the United States is getting more difficult, and it's getting more expensive. And then lastly, I'm going to briefly touch on this because I will admit the nickel market is still relatively broken. Ever since the short squeeze, which caused markets to shut down for a couple of weeks, liquidity and volumes being traded in the market has really thinned out. There's not a whole lot of price discovery. As we look at the chart, there isn't a whole lot of rhyme or reason to it, but I will say maybe this is a little encouraging for some of our customers. It does look like ever so slightly the price of nickel is beginning to drift back lower. And obviously part of that's going to be feeding from China being locked down, higher interest rates, all those things. But I think also just the natural unwind of this fear situation that we've been in for the last 2 months ever since the short squeeze, it's beginning to unwind a little bit. So I think we're beginning to see some more normalized prices. Obviously I drew in the moving average lines, so we're now below the 50-day moving average, which is just a signal that momentum is beginning to wane a little bit. So it looks like we're coming back down to earth as I look at this chart here. And as I mentioned, the volume traded. So this is a chart of the open interest on the London Metal Exchange, which open interest is just a fancy way of saying how many people are trading LME nickel right now. And you can see that ever since that short squeeze, a lot of traders, a lot of hedgers have just gone and left the market. They've closed up their positions. Some hedge funds are even suing the London Metal Exchange as we sit here today. So the LME's got a little bit of a credibility issue, if I didn't mention that in prior calls. And I think that's also contributing to kind of a wonky price action within the market itself. Now, unfortunately, offsetting a little bit of the price declines that we're seeing on nickel as it relates to surcharges, I would expect that in the coming month, maybe coming couple months, natural gas is likely going to begin getting implemented into the surcharges. I believe the threshold for most of the domestic stainless steel mills is $7 an MMBTU. We're currently, as of today, sitting right up around $8.50 an MMBTU. So the price of heating your facilities, the price of generating electricity is quickly getting more expensive again. And unfortunately, that is likely going to feed through with a surcharge going into stainless steel. It's not going to be massive. I don't expect it to be massive at this stage, but it is going to be an incremental adder on top of the traditional surcharge mechanism. So I know we had a little bit of doom and gloom in here. So there's certainly a lot to digest, and there are some real headwinds out there. I don't want to mince my words and say that everything is perfect, because we're certainly getting into a situation where the environment is a little less accommodative. And what I mean by that is we're beginning to hike rates. We're beginning to taper off the balance sheet at the Federal Reserve. So it is purposeful. We are when I say we, the administration, the central banks, they are attempting to cool some of these markets a little bit. So this is a concerted effort. But again, I think the real resounding theme of this call should still be, as we look at the manufacturing economy, I think on a relative basis, the manufacturing world is going to be just fine. And if anything, if we take some of Brent's comments to heart, looks like it could be pretty decent for a long time coming, assuming these lead times and these business activities maintain and customers don't walk from the business.
Nick, what I find interesting is I unpacked those last few slides you went over. If anybody missed last month's when you dove into the nickel situation, you brought up some points about nickel being factored into the surcharge. Could it be, was it scrap was the other that maybe start accounting for that rather than nickel? Some could be abandoning, not abandoning, but like moving off the LME, or like you said, have a trust in. And some of these things are kind of coming to fruition a little bit, or you're seeing some of that trickle in. And there was a kind of a phenomenon last month, right, where normally the stainless mills and their surcharges would be similar, where we saw Outokumpu and NAS have different, one taking it into account and one other. That was just kind of a one-time phenomenon, right?
For now, it was a one-time phenomenon. And the situation was basically that North American Stainless artificially picked a number, and I believe it was $12.60 a pound. And they just said, that's what we're going to plug into our surcharge mechanism. Whereas Outokumpu said, we're going to adhere to our LME pricing mechanism. That's not to say that this issue can't still come up again. If we see another short squeeze, or if customers just get fed up with pricing for whatever reason, you could see the mills revisit this discussion and say, we need to figure out a way to get off of the LME. And maybe, like you said, move to more of a scrap type of mechanism or something like that. I think that discussion is still on the table, and I very much so think the LME still has some very big credibility issues that it's going to have to deal with. But for now, with the LME nickel price drifting back lower, drifting back a little bit more into what I'll call a more normalized range, I would say that conversation is probably tabled temporarily.
Got it. Yeah, and you always bring in some interesting perspectives here. I mean, the latest one being about maybe natural gas being factored into that surcharge. Question from the audience: Do you see that possibly spilling over into things like carbon as well?
Yeah, I mean, I know I spend a lot of time talking energy, and I apologize for that. I have been, for personal reasons and for work reasons, been focusing a lot on the energy space, and I the main reason why I bring it up all the time is because I mentioned the phrase. It is really the workhorse of the manufacturing economy. You can't make anything. You can't melt metal. You can't move things around. You can't do technological innovation without energy. I mean, it is the lifeblood of all economies. And unfortunately, right now, we are seeing a very strong correlation between really all of these sources of energy, whether it's coal, whether it's natural gas, diesel fuel, crude oil. They're all very strong right now. And that's making it more difficult and more expensive to make all things. And for right now, that's creating inflation in the production of all finished goods. That can break at some point, but for now, that's the situation we're in. So I don't know if that answers your question, but yes, I mean, without a doubt, these energy markets are spilling into all things. I mean, I brought up the point with Brent, where the U.S. administration wants more energy, but in order to make more energy, we need energy going into the production of steel. So you do truly get this feedback loop where inflation begets inflation. People who want to get employed are requesting more money. All of these things are cycling into kind of a wage price spiral, if you will. And I don't mean to sound too doomsday. It's just that's sort of how these things happen. And we just haven't been in this inflationary environment since before I was born. So it's
we have seen some domestic mills start tacking on an energy surcharge. When you look at Europe, though, the energy surcharge is prevalent.
Yeah, and Mike, you didn't ask this question, but I mean, there is a real issue or risk, rather, of if natural gas prices go too high, things like, I think we've discussed this in prior calls, things like aluminum are very energy intensive. And there are risks that if natural gas prices keep going the way they are, one of two things either has to happen. Either aluminum producers need to pass through a much higher finished product price, or they shut down production. And we have seen a little bit of that within Europe, where they've curtailed some production. I believe that happened both on aluminum and stainless steel. So yeah, it's certainly something we want to keep an eye on.
Brent, when you mentioned you've seen some domestic factor in an energy charge, do you think that sticks for a long term, or you think that's kind of a temporary as things are going on right now?
They're just, right now, some of them are just dipping their toe in the water. So it's something that's pretty fresh. But again, the mills are struggling with these energy increases, like we're seeing across the country. But again, it is 10 times worse in Europe.
Guys, you've jam-packed the information here that we're right up against the hour. I have one question. Someone's been waiting patiently for Brent, so if you don't mind waiting over a minute or two. Brent, to your conversation regarding supply, what do the apparent demand versus supply numbers look like in the U.S.? Is there a gap? If so, why?
Well, I mean, that varies all over the map. I mean, the thing that I continue to hear from our sales forces are that customers have backlogs, but then when I ask them, do the customers have backlogs because their people short, their supply chain short, or because their business is up 20% over last year? So I don't think there's really a good way to measure what demand is versus supply, because there's so many mills in the bar and tubing industry, and trying to pull that data together, even if you can pull it out of some of these privately held companies, would probably be difficult. But I mean, all you got to look at is the lead times. I mean, the lead times tell you what demand and supply is. Normally structural tubing would be 1 to 2 months. Normally DOM would probably be 6 to 12 weeks, and it's 9 to 10 months. Higher SPQ, hot roll SBQ went in 2020, in March of 2020, it went from one of the major mills, they went from 6 weeks to 5 months in about a 3-week period. So it's all over the map.
Certainly interesting. Yeah. Well, I just reminded by one of our, it was a great suggestion by one of our viewers, remind everybody to, when we post these on YouTube, definitely subscribe to our channel, and we cut this apart too. So we have individual segments that you're able to share, and make sure you get all the latest updates there. Like I said, such great information that we're actually over time. So I'm going to duck out of the way and let Nick and Brent give us some closing statements for the month of May. Brent, to you first.
Well, one thing I'd like to say is, we all have to keep an eye on, the big R word. Are we going to a recession or not? I think things might slow down a little bit, but again, there is this backlog out there. But the one thing that I think is happening right now is, because carbon flat roll is peaked and maybe backing off a little bit, I would say tubing prices have pretty much peaked. I would think because scrap's backing off, that, the scrap surcharges for cold finish and hot roll SBQ have peaked in the month of May. Shred's going to be coming down, like Nick said. So your merchant bar products and structural steel products probably have peaked, unless there's some crazy demand out there that comes up that nobody's seeing right now. I think that at least for the month of May, prices are peaking, and I think they've kind of just settled down a little bit, But I think they've peaked in May, and we'll have to keep an eye this summer to see what's going to happen going forward.
You, Nick?
Yeah, I'll just add that to your point, Mike. We obviously ran a little over an hour today, and that's with good reason, because there truly is a ton to talk about. There will be points in time at some point in the future. I don't know whether that's 3 months, 6 months, or a couple of years, but there will be points where these calls will be much, much shorter, because we won't have as much to talk about, and we'll probably welcome those days. But we do really appreciate everybody's time. We appreciate everybody's questions, and we hope that we have other fans of Cup of Joe outside of just Alan Singleton taking selfies of us. But we'll keep on the path of doing these, and we'll present the information as it comes. There's just a lot to go over right now, and we appreciate everybody sticking with us.
And if I could note one last, you say you like charts. I think that's a very important element of Cup of Joe, right? This is a lot of information, and I think the visual aspect that you apply to these, Nick, is very important to helping people understand. And this stuff it's hard to take in. So you love charts, and I think everybody else does, and it helps to visualize everything. So that's my closing thought. So
Nick loves charts.
Nick loves charts. Thank you, everybody.
Thank you, everyone.
Thank you.
Bye-bye.